Can an E4 afford a home in today's market? In this video, we're going to talk about if homeownership is even possible as an active duty E4 using just the income on your LES, or if you're going to be stuck renting or living on base. Before I jump into the video, I have a free resource for you. I have an ebook that shows veterans everything that they need to know about their VA home loan benefit, from talking about the certificate of eligibility to talking about funding fees, squashing some of the myths and lies around VA loans, and also giving you a home buying checklist for you to follow when you're ready to go through the home buying process. So if you want to have access to that free ebook, click the link in the description below. It will give you free access so that you have it at your fingertips for when you are ready. The first thing we need to talk about are some of the qualifications that go along with the VA loan. Now, many of these things are going to be very common, that things that you guys already know, but I just need to make sure we're all on the same page here. The first one is going to be down payment requirement. The VA has no down payment requirement, which means that if you are purchasing a property with your VA home loan benefit, you essentially are not required to put money down like you would be if you were doing an FHA or a conventional loan. The next one is going to be private mortgage insurance. The VA does not have private mortgage insurance associated with purchasing a property. And what this means is if you were purchasing a property with a conventional loan or even an FHA loan and your down payment is less than 20%, you would have private mortgage insurance on your payment every single month that is protecting the lender and not protecting you. This could be anywhere between $100 to $200 per month, or even more depending on how much house that you're buying. So just look at this as an added savings that goes along with purchasing a house with your VA loan, because you're not having that down payment and also not having to worry about private mortgage insurance. The next one is going to be credit score requirements. Did you know the VA does not have a credit score requirement associated with it? But before you go writing that down, this is the thing that you need to know. The VA is not the one that actually does the loan. It's lenders that do the loan. The VA just determines who's eligible and guarantees the loan. So when purchasing a property with your VA loan, you need to understand that the lender that you're working with is going to have their own requirements associated with working with them. And a lot of times they'll make it sound like that's the VA's requirement. So if you're working with somebody and they're telling you the minimum credit score that you must have is 620 or above, like most of those very common VA lenders out there, you need to know that that is actually not the gospel. That is not what it's going to be for every lender. That's just what it's going to be with them. Most of them do require 620. Some will let you be as low as 580, and very few will even accept anything less than that. Me and my team have helped veterans in the 580 range. Some of them we've even helped in the lower or below 580 range as well. So if you find yourself in that position and you want to connect with somebody who has experience in helping veterans navigate the VA loan process from start to finish, no matter where you're at in the credit spectrum, reach out to us, give us a call, shoot us a text. We're happy to help guide you through this entire process. The next thing we need to talk about is going to be debt to income. If you've ever tried to buy a house before, or you've even had a conversation with friends and family regarding buying a house, you probably heard of the phrase DTI, or debt to income ratio. And this is something that is factored in when it comes to all different types of loans. You see, conventional loan requires 50% or less. FHA is going to be right at about 57% or less. USDA, about 41% or less. But what about VA's requirement? Well, the VA actually does not have a debt to income ratio associated with it. They use a little thing called residual income, which is a table that is laid out based on different regions: Northeast, Midwest, South, and West. And then they look at your household size. So depending on your household size determines how much money the VA expects you to have left over after all of your bills are paid. For example, I've seen veterans be able to purchase a home with a 65+% debt to income ratio. Had they been doing any other type of loan, they would not have been able to qualify to be able to purchase a home at all. This is just a little bit of an example of what sets the VA apart, similar to some of the other things I mentioned before, but I would say this is one of the biggest ones. Many veterans are told that they need to have a lower debt to income ratio in order for them to be able to purchase a home. And that's not entirely true. That may be true with just the lender that they spoke to, or even the person who told them a myth. The next thing we need to talk about is going to be your LES. And the reason for this is because this is what lenders are going to use to determine what you qualify for. I found an example of an LES online. We're not going to use these exact numbers for our example later when it comes to monthly payment and qualifications, but I just wanted to show you an example of what your LES will look like and how lenders read it. Now, on the far left column, you'll see your entitlements, which will have your base pay, your BAS, your BAH, and if you live in a high cost area, you're going to be receiving what's known as COLA. Most commonly, I've seen COLA in places like Hawaii, but we're not going to use COLA in this example. We're just going to be using base pay, BAS, and BAH. Now, keep in mind, if you are in the PCS process and you are moving from one duty station to the next and you haven't actually got there just yet, what you'll see on your BAH or on your LES under BAH is going to be the BAH that you're receiving at your current duty station. The lender that you're working with should know that they can go and pull the BAH for the new duty station that you're going to be at, so they can make sure they can accurately factor that in. Because in some cases, your BAH could be going up, and if they're using a lower BAH amount to qualify you, they could show that you don't qualify for as much, or even show that you don't qualify at all. And then also on the flip side of this, if you're going from one duty station to the next and your BAH is actually going to be going down, they could show that you qualify for more than you actually do. So it's important that your lender has a solid understanding of how to properly read this to navigate you through the process the right way. The middle column that you'll see here is going to be your deductions. These are for things really for like taxes, like federal and state taxes, Social Security, Medicare, things like that. And then the far right column is going to be your allotments, as well as your allotments for things that you may have set up, like maybe a TSP loan or maybe money that you have going into other accounts that you have. It really just depends on each person's unique situation there. But this is essentially just an example of an LES that I wanted to show you guys so that you guys have an idea of how lenders are reading this. Now, when it comes to the BAH that we're going to use for this example, we're going to be using an E4 that is married with 2 dependents. So this is going to be a family of 4. And when we pull a BAH table, it is going to show us BAH with dependents and BAH without dependents. In this situation, we're going to be using BAH with dependents. And in San Antonio, Texas, where I'm currently located and where I wanted to use for this example, BAH here with dependents for an E4 currently is $1,863. The next thing that we're going to look at is going to be BAS. BAS for an enlisted service member is going to be $452.56. Now, keep in mind, these things are subject to change going into 2024, and you will potentially be seeing a slight increase in some of these numbers. So if what I'm mentioning today seems a little bit lower than where you actually are, keep in mind I'm using the 2023 BAH table and BAS table as well. The next thing that we need to look at is going to be your base pay. The base pay for an E4 that has been serving 4 years as of December of 2023 is $2,631. So now this is going to bring our gross monthly income for our base pay, our BAS, and our BAH to $4,946. The next thing that we need to look at is what is going to be our net income after we subtract all of the taxes that are going to be coming out, like we mentioned on the LES. Before I jump into deductions and all the other things associated with purchasing a house with your VA loan, I have to ask, have you gotten value from this video so far? If so, do me a huge favor and hit the like button down below. What this tells YouTube is that this information is valuable and it allows it to be pushed out to more veterans just like yourself so they can learn this valuable information. Okay, so we have our total gross income at $4,946, and this accounts for our base pay, our BAH, and our BAS. But how much of that income is taxed? Well, the only part of that income that is going to be taxed is going to be your base pay. BAH and BAS is considered non-taxable income, which essentially means that it just helps you qualify for more house because a large chunk of your income is not being factored in against your taxable income. When it comes to the taxable income, the $2,631 that you're receiving for base pay is what is going to determine the portion of income that is getting taxed. Because I'm using the state of Texas, there is no state income tax, which means that the only things that we're going to be factoring in is going to be the federal tax, Social Security, and Medicare. And what this came out to, due to this family and household size, was right at about $233 per month, which means that after you subtract the $233.65 per month from the $4,946, our total net income is now going to be $4,712.35. The next thing we need to go over is our debt situation. Because I wanted to try to make this scenario as real as I possibly could, I factored in about $800 per month in debt against this veteran's situation. Now, you may not have this much debt or you may have more, but this is going to be the part where you're going to want to subtract your total monthly debt that is being reported on your credit for things like auto loans, personal loans, credit cards, even student loans, to determine how much money you have going out against your net income. Again, I used $800 for this example for this particular veteran. Let's call him John Doe. And John Doe's debt is $800 per month, which means that after subtracting the $800 from his net income, the new net income minus all liabilities is going to be $3,812.35. The next thing we need to take into account is going to be maintenance. You see, on the VA guidelines and on the VA loan analysis, they use this little ratio to determine how much money they want you to have left over in the event that you have certain repairs or things that need to be taken care of on your home. And this is a calculation based on the square footage of the home. I used a square footage home of 2,000 square feet for this example to determine how much money the VA wanted you to have available for maintenance. And for maintenance on a 2,000 square foot home on a VA loan is going to be $140. Now keep in mind, this is not a debt and this is not a bill that is added on top of your ability to qualify. This is just solely money the VA wants you to have additionally left over. When I subtract that $140 from $3,812.35, that brings us down to $3,672.35. The last thing we need to do with these numbers is to determine what the VA's guideline is for this family's household size regarding the residual income like we talked about at the beginning of the video. With our household size as a family of 4 in the southern region, the VA is going to require you to have $1,067 left over after all of your bills are paid. So what we're going to now do is subtract that $1,067 from the $3,672.35 that we had to determine what our max monthly payment can be. And this comes out to $2,605.35. Let's just round it to $2,605. The next thing we need to do is now find a home. We know what our monthly payment can be, but we need to find a home that fits that requirement. So when I look at the San Antonio area and I look at what the median home price is, depending on where you check, you're going to get a few different numbers. For example, Redfin is saying the median home price is right at about $256,000. And then if you look at Zillow, it's saying currently $254,000. And Realtor.com was saying $285,000. And because I wanted to look around a specific base, I used Lackland Air Force Base, which is a very common place here in San Antonio. I wanted to use also a more worst case scenario for our median price, and I used $285,000 to determine what I was going to look for when it came to a home price. So I found a home here that is about 10 minutes from Lackland Air Force Base, which the picture you'll see on screen, that is at $280,000. It is 1,900 square feet, 3-bedroom, 2-bath. It should be perfect for our family of 4 here. And this is going to now be the home that we're going to use to determine whether or not a veteran can afford to purchase this house as an active duty E4. So now let's talk about monthly payment and see how much this home is going to cost this active duty E4 every single month. Before we do that though, we need to understand the funding fee. You see, the VA has a funding fee that is associated with using the VA loan if you don't fall into one of a few different categories to determine whether or not that you are exempt from the funding fee. If you want to understand exactly what funding fees are and how they work, I have a whole video on that I'll link up here and in the description below. You can check that one out. But for a veteran that is using the VA loan, first time use, and you are putting 0 down, the funding fee is 2.15% of the sales price. And this gets rolled in to the loan, essentially being affected in your monthly payment. It's not something that you're required to pay up front whatsoever. Now, on a $280,000 sales price with a 2.15% funding fee, property taxes are at about $467 per month on this property, and homeowners insurance at about $150 per month. Our total monthly payment is going to be $2,529.50. Now, let's circle back to how much we had to have left over with our residual income. If we go back and we look at that number, our residual income requirement was right at $2,605, which means that this property, located less than 10 minutes from Lackland Air Force Base, essentially is doable for an active duty E4 family of 4 purchasing a property as a young active duty service member. So there you have it. An active duty E4 is actually able to purchase a home in today's current market. If you want to know whether or not you're able to purchase a home in this market, click the link below, set up a discovery call with me and my team. And if you want to know how to purchase 2 properties with the VA loan at the same time, check out this video right here.